Hey there, money explorers. Welcome to another exciting journey where we uncover the mysteries of money. Have you ever wondered how prices go up and down? It's like a roller coaster ride, isn't it? One day your favorite toy costs a certain amount, and the next day it's different. It's like a secret code. But don't worry, we're here to crack it. Together, we'll uncover the reasons behind these changes and become money detectives. Today, we're going on an adventure to learn about something called inflation. Inflation is when prices for things like toys, food, and clothes go up over time. It's a big word, but we'll make it fun and easy to understand. Don't worry, it doesn't involve balloons. Instead, it's all about how much things cost and why they sometimes get more expensive. We're going to meet the Federal Reserve, a group of people who help control prices and keep our money safe and sound. They have a very important job, kind of like superheroes for our economy. Get ready for a wild ride through the world of money. We'll explore how the Federal Reserve works, why inflation happens, and what it means for you and your family. So buckle up, money explorers, and let's dive into the fascinating world of economics together. Imagine the Federal Reserve as a wise old owl, always watching over the United States economy. They're like the grown-ups in charge of money, making sure everything runs smoothly. Just like grown-ups set rules in a house, the Fed sets rules for banks and money. They do this to keep our economy healthy and strong. Inflation is like when prices slowly go up, up, up. Remember that yummy candy bar you love? What if one day it costs twice as much? That's inflation. The Federal Reserve, our wise old owl, has special tools to control inflation, like a car's gas pedal and brakes. They can slow down inflation or speed up the economy when needed. Interest rates are like the cost of borrowing money. They determine how much extra you have to pay back when you take out a loan or use a credit card. Let's say you want to buy a brand new bike, but you need to borrow money from your parents. You don't have enough saved up in your piggy bank, so you ask them for a loan. Your parents might charge you a small interest rate, meaning you'll need to pay back a little more than you borrowed. For example, if you borrow $100 and the interest rate is 5%, you'll have to pay back $105. The Federal Reserve, often called the Fed, can raise interest rates to slow down inflation. Inflation is when prices for goods and services rise, making everything more expensive. When it costs more to borrow money, people borrow less and spend less, which can help lower prices. Higher interest rates make loans and credit cards more expensive, so people think twice before making big purchases. This reduced spending can help bring down inflation and stabilize the economy. So while borrowing money can help you get what you want sooner, it's important to understand the cost of borrowing and how interest rates work. By being smart about borrowing, you can make better financial decisions and avoid paying more than necessary. Section 5. Reserve requirements, holding back the money. Imagine banks have piggy banks full of money. These piggy banks represent the reserves that banks must keep on hand. The Federal Reserve, often referred to as the Fed, can instruct banks to keep a certain amount of money in their piggy banks. Think of it as a timeout for some of the money, ensuring it stays put and isn't used for lending. This practice is known as reserve requirements. It's a crucial tool used by the Fed to control the amount of money circulating in the economy. When banks are required to hold back more money, they have less available to lend out to businesses and individuals. This means fewer loans and less credit in the market. By holding back money, the Fed can help slow down inflation. With less money available to spend, the demand for goods and services can decrease, which can help stabilize prices. Reserve requirements are a balancing act. They ensure that banks have enough reserves to meet customer withdrawals, while also controlling the amount of money flowing through the economy. This mechanism not only helps in managing inflation, but also ensures the stability and security of the banking system. By keeping a portion of their funds in reserve, banks are better prepared for unexpected withdrawals and financial uncertainties. Ultimately, reserve requirements help maintain trust and confidence in the financial system, ensuring that banks operate smoothly and efficiently. Section 6. Open market operations, buying and selling to control money. The Fed can also buy and sell government bonds, which are like loans to the government. When the Fed buys bonds, it's like putting more money into the economy. This can make prices go up. When they sell bonds, it's like taking money out of the economy, which can make prices go down. It's like a balancing act with money. Section 7. Why should we care about inflation? Why should we care about inflation? Well, when prices go up too fast, it can be hard to buy the things we need and want. Imagine if the price of your favorite toy doubled. That's why the Fed works hard to keep inflation under control, so we can all afford the things we need. Section 8. Keeping things balanced. The Federal Reserve is like the economy's superhero, working behind the scenes to keep things balanced. They use their special tools, interest rates, reserve requirements, and open market operations to control inflation and keep our economy healthy. So next time you hear about the Fed, remember our wise old owl, working hard to keep money matters running smoothly.